James gets asked the same question more than any other. Friends, cousins, co-workers at lunch, they all eventually find their way to some version of, I've got a little money saved up. What do I actually do with it? The honest answer used to feel complicated even to James back when he started. Account types, ticker symbols, order types, the difference between a fund and an individual stock. The vocabulary alone is enough to make most beginners close the app and decide to think about it later. This video is the complete answer James wishes someone had given him on day one. Why investing matters, why stocks specifically, how to actually open an account and place a trade, what to buy, when to buy it, and how to think about your own personal situation along the way. By the end, you will have everything needed to make your first investment and to keep investing intelligently for the rest of your life. There are two fundamental reasons to invest, and understanding both changes how seriously you take the decision to start. The first is protection against inflation. Prices rise over time. The Federal Reserve targets roughly 2 to 3% annual inflation as part of maintaining a healthy economy, and you feel this in ordinary life constantly. A meal that cost $8 several years ago might cost $12 today. Money sitting in a standard checking or savings account, earning close to nothing, loses purchasing power every single year it sits there. $50,000 held in cash for 6 years buys meaningfully less than it would have bought when you first saved it, not because anything was spent, but because the prices of everything else quietly climbed around it. Historically, the broad market has returned approximately 8 to 10% annually over extended periods. Investing is the most accessible way for an ordinary person to keep their money growing faster than inflation erodes it. The second reason is compounding, the principle that returns generate their own returns over time. $1,000 earning 10% annually produces $100 in year one. In year two, the 10% applies to the new total of $1,100, not the original $1,000. Continue this for 20 years, and the original $1,000 grows to roughly $6,700, not from adding more money, but from returns compounding on previous returns. The same principle scales upward. $1 million earning 10% generates $100,000 annually without any additional labor. Larger capital bases produce proportionally larger returns from the identical percentage, which is the entire mechanism behind the phrase, money makes money. There are many categories of investment available: real estate, commodities, collectibles, private business ownership. Stocks earn particular attention for beginners because they combine three qualities that few other assets offer simultaneously: accessibility, historically predictable long-term returns, and liquidity. Liquidity matters more than most beginners initially realize. A liquid asset can be converted to cash quickly and easily. Real estate, despite being a legitimate long-term wealth-building tool, is notably illiquid. Selling a property typically requires weeks or months, a buyer, and a full transaction process. Stocks, by contrast, can be purchased in the morning and sold the same afternoon if necessary, with funds typically available within a few business days. On predictable returns, the broad market, best represented by the S&P 500, an index tracking the 500 largest publicly traded American companies, has historically delivered that 8 to 10% annual average over long holding periods, despite significant short-term volatility along the way. $100 invested in the broad market in 1980 would be worth many thousands of dollars today, a return that significantly outpaces what the same $100 would be worth after adjusting purely for inflation. The market does not move in a straight line. There are declines, flat stretches, and genuine corrections, but the long-term trajectory across nearly a century of data has consistently been upward. Investing requires opening what is called a brokerage account, functionally similar to a bank account, but specifically designed to hold and trade investments, and almost always opened online in a matter of minutes today. There are two broad categories worth understanding: retirement accounts, in the United States, the 401k offered through an employer, and the IRA opened independently, provide meaningful tax advantages in exchange for restrictions on when the money can be withdrawn without penalty, generally not before retirement age. Standard taxable brokerage accounts offer no special tax treatment, but provide complete flexibility with capital gains taxes owed when investments are sold at a profit. Decades ago, placing a trade required calling a licensed broker who executed the order on your behalf. Today, established platforms, Fidelity, Charles Schwab, and several newer mobile-first brokerages allow anyone to open an account and place trades directly, with no broker intermediary required for standard transactions. Once an account exists, the next decision is what to invest in. Beginners generally choose between individual stocks, purchasing shares of specific companies, and funds, which hold many companies at once. Individual stock selection can be a legitimate strategy for someone willing to research extensively, but it carries meaningfully more risk and volatility than diversified fund investing, and it requires ongoing attention that most beginners are not equipped to provide. A company that looks dominant today can struggle for decades. There are well-known examples of individual stocks purchased at a high price that took many years, sometimes longer than 2 decades, to return to that original value, while the broad market climbed substantially higher over the same period. This is why most financial professionals direct client funds primarily into index funds and exchange-traded funds rather than individual stock selection. An index fund pools investor money and automatically tracks a market index, such as the S&P 500, rather than relying on a manager actively picking individual winners. Because there is no active manager making selections, the fees on index funds are dramatically lower than actively managed mutual funds, which charge ongoing fees specifically to compensate a manager who historically underperforms the index they are trying to beat in the large majority of cases over extended periods. Buying a single index fund tracking the S&P 500, identifiable by ticker symbols like VOO or similar broad market funds, instantly diversifies an investment across all 500 component companies simultaneously. One purchase, broad exposure, minimal fees, no requirement to predict which individual company will outperform. Every publicly traded investment has a short code used to identify it for trading purposes, similar in concept to an airport code. Apple trades under AAPL, Microsoft under MSFT, and a broad S&P 500 index fund commonly trades under VOO. These codes are simply the shorthand used to search for and purchase a specific investment inside a brokerage platform. The most common reason beginners delay investing is the belief that the market has already risen too far, or that current prices represent an unusually bad time to begin. This concern, while understandable, does not hold up against the historical data. The S&P 500 spends a meaningful share of all trading days, roughly 1 in 12, sitting at a new all-time high. New highs are followed more often than not by further new highs over subsequent years. Waiting for a clear dip before investing means frequently missing substantial gains while waiting for a signal that historically rarely arrives in the form most people expect. The data on missing the market's best days makes this concrete. An investor who missed only the 10 best trading days over a 30-year period would see their total returns reduced by more than half. Missing 20 of the best days reduces returns even more dramatically. These best days cluster unpredictably and often arrive during periods of high volatility, meaning the investor sitting in cash, waiting for conditions to feel safer, is statistically very likely to be absent for the recovery when it happens. A well-known finance writer summarized this dynamic memorably. Rather than trying to determine whether now is a good time to buy, the better approach is simply to buy consistently regardless of the current price level. Research on valuation metrics confirms that buying at a higher relative price does tend to produce somewhat lower returns over the following 5 years specifically. but extend the holding period to 20 or 30 years, and that relationship largely disappears. Across nearly every rolling 20-year period in market history, including dividends, U.S. stocks have not produced a negative real return. A useful real example: commentators in the early 2010s frequently described the market as significantly overvalued at levels that, viewed today, represent a small fraction of where the index eventually climbed. Waiting for valuations to feel comfortable would have meant missing over a decade of substantial growth. A frequent question from beginners is how much income or savings should exist before investing makes sense. There is no universal number, but the more relevant question is sustainability rather than total amount. For someone very early in their career with minimal savings, investing a small amount may matter less than investing in skills and earning capacity first. Courses, certifications, or experience that meaningfully increases future income. Once a stable income exists, and a portion can be set aside consistently without disrupting essential expenses, investing becomes genuinely worthwhile, even starting with a modest monthly amount. James began investing with roughly $100 to $200 monthly when his annual income first reached the mid-50,000s, directing any bonuses or tax refunds into the same account as supplemental contributions. Before committing to a specific strategy, it is worth honestly assessing personal risk tolerance, investment timeline, and financial goals, because these vary significantly between individuals and should shape the approach taken. Someone with decades until retirement can typically tolerate more short-term volatility because time allows for recovery from downturns and continued contributions throughout. Someone approaching retirement within the next several years generally benefits from a more conservative approach, since there is less time to recover from a significant decline before the money is needed. It is worth restating clearly: the historical 8 to 10% average annual return is exactly that, an average across many years, some strongly positive, some negative, occasionally flat for extended stretches. Major downturns, including significant financial crises and sudden market shocks, have occurred repeatedly throughout market history. The average return does not arrive predictably every single year. It emerges from the combination of good years and bad years over a sufficiently long timeline. When deploying money into the market, two general approaches exist. A lump sum investment puts the entire amount in at once. Dollar cost averaging spreads the same total across regular intervals, for example, investing $1,000 monthly over a year, rather than $12,000 all at once. Both approaches are mathematically reasonable, and historically, lump sum investing has slightly outperformed averaging in the majority of historical periods, simply because markets trend upward more often than not. However, dollar cost averaging carries genuine psychological value. It removes emotion from the timing decision, naturally purchases more shares when prices are lower and fewer when prices are higher, and can be fully automated so that contributions happen without requiring an active monthly decision. If James were starting from scratch today, the sequence would be straightforward. First, internalize why investing matters, the inflation protection and the compounding mechanism covered earlier. Second, open an account, either a retirement account or a standard brokerage account through an established and reputable platform. Third, direct the bulk of contributions toward a broad index fund tracking the S&P 500 or a similarly diversified benchmark, the most stable, low-maintenance foundation available to a beginner. Fourth, continue learning gradually. Investing becomes considerably less intimidating the more familiarity accumulates with the basic mechanics and vocabulary. The overwhelming majority of long-term wealth built through investing comes not from picking the perfect stock or timing the perfect entry point, but from starting consistently, choosing broad and inexpensive diversification, and continuing without interruption across decades. The technical vocabulary that makes investing feel intimidating at first, account types, ticker symbols, order mechanics, becomes routine within the first few transactions. James did not start with sophisticated knowledge. He started with a small monthly contribution, a broad index fund, and the decision to keep going, regardless of what the market did in any given month. That decision, repeated consistently, is the entire foundation of everything that compounds from here. See you in the next video. Thanks for watching. Tell me what you think in the comments, and like and subscribe to James Invests for more content like this.